All right, welcome. Today, we're going to build a bridge. Now, on one side of this bridge, you've got all this data about a company's sustainability performance. And on the other side, cold, hard financial valuation. For way too long, these two have been treated like they're in completely different universes. While on this explainer, we're going to show you exactly how to connect them.
So, this is the big question, right? It's the one that everyone's trying to answer. We all kind of know, intuitively, that managing environmental, social, and governance factors, ESG, has real value. But how do you go from that gut feeling to an actual figure, a number you can plug into a valuation model? That is the puzzle we are here to solve.
And here's where the problem really lies. You've got sustainability data over here, and people often see it as fuzzy, non-financial, maybe qualitative, something that plays out over the long term. And then over here, you've got financial valuation, which is all about being rigorously quantitative, super model-driven, and focused on forecasting cash flows. I mean, they're speaking two totally different languages. Our job is to be the translator.
So here's how we're going to do it. This is our game plan. First, we'll look at that valuation gap and break down the fundamental levers of value. Then, the fun part, we'll connect a company's performance to its profits and its risk. And finally, we'll put it all together to see how it works out in the real world. Let's dive in.
Okay, first things first. What actually drives a company's value? Before we can even begin to connect sustainability to it, we have to start with the absolute fundamentals. Look, we're not trying to reinvent finance here. We're just adding a really crucial new lens to a classic, time-tested framework.
So, no matter what business you're looking at anywhere in the world, its value really just boils down to these three levers. How profitable is it? How fast can it grow those profits? And of course, what's the risk tied to all that? These three things determine a company's future cash flows and the rate we use to value them. How much we discount that future money based on how risky it is. Every single sustainability impact has to flow through one of these channels, period.
All right, let's start building that bridge. We're going to begin with the most direct connection there is. How sustainability hits a company's profit and cash flow. And this isn't some abstract theoretical thing. We're talking about the real, tangible effects on the money coming in and going out of a business.
So let's start at the very top of the income statement, revenue. Just think about it for a second. When a company develops more sustainable products, that's not just a nice ethical thing to do. It's often meeting brand new customer demands, it's opening up new markets, and it's building a brand that people actually want to get behind. All of that drives sales.
What's so great about this slide is how it makes that idea totally concrete. Let's take the chemicals industry. There's a metric from the Sustainability Accounting Standards Board, or SASB, that looks at revenue from products designed for use phase efficiency. Now, a company that scores well on this isn't just doing good, it's meeting a real customer need. So when an analyst sees that, they have a solid data-driven reason to bump up their revenue forecasts in a discounted cash flow model.
But of course, profit isn't just about what you bring in. It's also about what you have to spend. So the second channel here is how sustainability performance affects a company's cost structure and, by extension, its operating margins. And believe me, these costs can stack up really fast. Mismanaging sustainability isn't just a PR nightmare, it's a direct hit to the P&L. You've got compliance costs, waste, legal fees, but the opposite is true too. Every little improvement in energy efficiency or reduction in waste is a direct saving that goes straight to the bottom line.
Okay, next up, let's talk about assets. A company's assets, everything from its factories and equipment to its brand reputation. That's what it uses to generate value. And sustainability issues can directly impact how well those assets can do their job.
And this is a perfect illustration of that point. For a solar energy company, land rights are a huge asset. But, as this SASB metric shows, if a project gets delayed because of ecological concerns or community pushback, that asset is now impaired. It's not generating revenue. That leads an analyst to directly lower their cash flow projections. On the flip side, strong community engagement actually protects and enhances that asset's value.
And finally, let's look at the other side of the balance sheet, liabilities. See, poor sustainability performance doesn't just chip away at your assets. It can actively create brand new financial obligations that literally weigh down the company's value.
Just think about things like environmental spills or major labor disputes. These aren't just one-off costs. They create real, long-term liabilities on the balance sheet. We're talking fines, legal settlements. These are direct cash outflows that not only drag down the company's value today, but also send a big signal about higher risk in the future.
So we've covered the cash flow part of the equation.
Now let's tackle the other critical piece of our bridge, risk. This is where sustainability analysis gets really powerful because it helps us refine the discount rate to get a much more accurate picture of a company's true risk profile.
Okay, so let's just do a quick reset on what the discount rate is. At its core, it's just the rate of return that investors demand to compensate them for taking on risk. A higher discount rate means future cash flows are worth less today, which means a lower valuation. You can almost think of it as the price of uncertainty. So, the better a company is at managing its sustainability risks, the lower its uncertainty.
So, the discount rate is usually calculated using the company's weighted average cost of capital, or WACC. I know, it sounds complicated, but it's really just a blend of two things. The return that shareholders demand, that's the cost of equity, and the interest rate paid to lenders, the cost of debt. And sustainability performance can move the needle on both of them.
Let's make this real with an example for the cost of equity. Imagine an iron and steel company that operates in a place with super high water stress. That's a data point captured by a SASB metric. Well, that company faces a much bigger risk of its operations getting disrupted. That operational volatility increases the company's beta, which is just a measure of its volatility versus the market, and that leads directly to a higher cost of equity, and you guessed it, a lower valuation. Now, the connection to the cost of debt is getting even clearer these days. Lenders are systematically baking ESG performance into their credit risk analysis. We're seeing more and more evidence that companies with better ESG performance actually get a lower cost of debt. And it gets even more direct with things like sustainability-linked loans, where a company's interest rate is literally tied to hitting specific ESG targets.
Okay, deep breath. We've built both sides of our bridge, we've connected sustainability to cash flow, and we've connected it to risk. Now let's pull it all together and see what valuation looks like in practice.
If there's one slide to really focus on, it's this one. This is your key takeaway. It's a clear map showing how specific types of sustainability data connect directly to those 4 channels of financial impact. So whether you're looking at a metric on product innovation that drives revenue, or data on waste management that affects operating margins, or info on risk management that influences the cost of capital, this is the framework. This is how it's done. And that really gets to the heart of it. This whole process isn't about throwing out traditional financial theory. It's about upgrading it. By systematically including all this new data, we are simply correcting for old blind spots to get a much more accurate, much more complete assessment of a company's true long-term value.
So, let's just end with this thought. If we can now translate sustainability performance into dollars and cents, and it's becoming a critical skill, what does that mean for the future of finance? We might just be watching a fundamental shift where understanding sustainability isn't some niche specialty anymore, but a core, absolutely non-negotiable skill for anyone trying to value a business. The bridge has been built. The real question is, who's ready to cross it?